Hey everyone, Meet Kevin here. Tesla just reported a Q2 deliveries after the most challenging quarter in Tesla's history, following some intense Shanghai lockdowns, the likes of which Tesla hasn't had to experience before, at least not to this severity. Well, folks, delivery estimates have been cut from Q1. In Q1, we delivered just over 305,000 vehicles. And this pacing becomes very important because that's about 100,000 vehicles per month within a 3-month quarter. Now, we delivered slightly less than that. I'm going to show you the estimates versus the actual deliveries, and I'm going to talk to you about what I think of this as an investment, as a potential investment opportunity. Now, of course, I want to be crystal clear. This is impersonal information, and this is not financial advice for you and your portfolio, but I will be reviewing some examples of rates of returns that someone might expect from Tesla if certain conditions are met. But first, let's go through some of the delivery figures. So here we go. We have vehicle production and deliveries just out this morning. Over 258,000 vehicles were produced, and there were deliveries of over 254,000. You could see that number right here, 254,700. The estimates came in slightly higher than that, and these estimates really depend on which company or researcher you look at. For example, FactSet came in at 263,000. Bloomberg was closer to 268,000, and other estimates were around 255,000 along the lower end. Now, folks, see this number right here, the S and X deliveries? This number I actually think is quite fascinating, and the reason for that is in the last quarter we delivered 14,700 S's and X's, and despite Shanghai being shut down, it looks like we're still able to ramp production of the S's and X's. This is likely because many of these are produced at the Fremont facility in California, but I like seeing the increase from 14,700 to 16,162. That represents an almost a 10% increase in the production for S and X vehicles, which these are higher margin vehicles, right? Even a few extra thousand of these are going to help us push up margins at the company. And of course, we know that margins at Tesla are the most important thing. It's one of the things and one of the reasons that Tesla has the price to earnings multiple that it does. But remember, folks, this is not just a car company, and this is some of the other information that we have to talk about. So if we go ahead and look at some projections going forward, because I actually think, hey, you know what, after Q2, that's probably going to be the roughest quarter, as long as we don't have another crazy kind of Shanghai-style outbreak where Xi Jinping decides to shut down the country again. He just left the country for the first time since prior to the pandemic and visited Hong Kong, which some are saying, well, it's not really leaving the country, okay, he's still over in China. But I understand that Hong Kong is obviously separate. It's an autonomous region, but we're not getting into politics here. The point is that finally it seems like he's relaxing a little bit on some of the crazy COVID-0 policies, although he's declaring victory over COVID. So maybe the argument here is, well, if we see cases come back, so will his harshness and his attitude, right? It's easy to declare victory when cases are down after some crazy lockdowns. If problems come back, we'll have bigger problems. So there are future risks to other quarters that we could still have shutdowns in China, especially for Tesla. And so that would be very bad. But if we do look past this second quarter, this second quarter's EPS, its earnings per share, is going to be less than what we had in the first quarter, likely at least, unless we had some crazy kind of margin movement. I mean, the 50,000 fewer vehicles were brought in, and we're ramping Giga Berlin and Giga Austin, Texas. It's very unlikely EPS is going to be anywhere near like what we had in Q1. But of course, before we get into some long-run projections, we would be silly not to address some of the FUD that's going on with Tesla right now. First, we've got investigations into autopilot across pretty much the entire world. Even here in America, multiple accidents are being partially blamed on either the driver or on the autopilot system, especially in scenarios where autopilot tends to degrade, such as heavy weather, which could be heavy snow, heavy rain, or whatever, different types of terrains, right? So these are problems, because in the future, we could end up seeing autopilot investigations lead to limitations of autopilot features, which could potentially make Tesla autopilot software and its suite less desirable for people to pay for, either as an a la carte option, which Tesla is now offering a few different options, one for $6,000 and one for $12,000 for different levels of advanced driving assistance software, or ADAS. But we could also see just a limitation like what we've seen in Europe, where vehicles, Teslas, can have a navigation route set, and if you have it on navigate on autopilot, the vehicle will drive on the highway, overtake vehicles that are driving too slowly, change out of the fast lane, drive as a human should on the freeway with reasonable safety and care, maintaining distance to other vehicles, and it will actually move to an exit lane and exit the highway for you without intervention. Europe now wants individuals to verify that the car should do so by hitting the blinker again or whatever, and sort of this extra step has been layered on. But it's interesting to me that a lot of the FUD that we see around autopilot implies that the whole thing's just going to get scrapped, when I think the reality is these investigators deal with so many auto accidents, they realize that the death rate of someone in a vehicle driving under an autopilot system is somewhere around 10x fewer than the death rate of someone just driving themselves in a regular vehicle. So I actually personally think regulation for the autopilot industry is great, and it's wonderful that Tesla can be a forerunner in this field. Now, of course, this has brought up thoughts about, hey, but what about the layoffs on the autopilot team? Yeah, well, from what we know, these are labelers who have been laid off. And there's an idea that Tesla perhaps has gotten to this level of advanced computer labeling to where they actually don't need humans to tell the computer anymore, this is a stop sign, this is a bollard. And they can now use computers and process tens of thousands of images per second, rather than labelers processing maybe one image a second, going, yep, stop sign, bollard, traffic light, right? This is good. This is all part of the advancing nature of Tesla's autopilot. Now, some folks are wondering, hey, but what about this argument that Elon Musk makes fun of them and says, well, investigators are the fun police? Well, I mean, this has to do with the fact that the fun police says we can't have a boombox as our horn for when we honk. So, okay, all right. I understand. It was kind of entertaining for while it lasted. I used to drive by cops who were kind of just hanging out at the side of the road, and I'd play my horn and I'd go, da, 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 da. This is wonderful. Okay, these are probably not things you should do. These are probably things that are going to get you in trouble anyway, or just distract other people. So I get it. Of course, Elon Musk in a recent interview suggested, hey, but we're the only auto company other than Ford that hasn't gone bankrupt in America. And right now we've got these furnaces. They're like money pit furnaces of Giga Berlin and Giga Texas. And if you listen to insider reports from these factories, they're chaos. These factories are complete chaos. But honestly, chaos is what you would expect at a new factory. In fact, most startups are, quite frankly, chaos. I am starting a massive real estate company with a little slice and hint of SaaS, which more details to come on that. You could actually sign up for more information by going to metkevin.com/Series A. When we have more information, we'll send it out. We're very excited about that, expecting to launch somewhere around August 1st for course members only, for about a 30-day window as sort of a first round. So if you're a course member, you'll have an opportunity to jump in there. But anyway, so this bankruptcy argument, look, Tesla's got over $17 billion in cash, and we expect that each factory, Giga Berlin, Giga Texas, could take somewhere around $5 billion to fully build, and potentially up to $8 billion to fully ramp. We're not expecting that Tesla's going to run out of cash, because they actually are a positive cash flowing company. They make money every quarter. Now we expect they're going to make less money this quarter because they delivered less vehicles. But see, the beautiful thing about Tesla actually making money is every single day that goes by, more cash is going in than is leaving. Now, we'll take a look at the cash flow statements this quarter when they come out on July 20th to see if anything has shifted. How much are these companies or these factories really burning at this point where we're in the ramp phase? So there is a potential that if we start seeing a negative cash flow, there could be a big adverse reaction on stock valuation, because folks do believe that if Tesla has negative cash flow, Tesla's going to have to raise money by maybe doing a bond offering or issuing stock. If Tesla is positive cash flow or cash flow positive, then maybe we don't have to do that. We just need to deliver more cars, which is what the trajectory is delivering more cars. In fact, one of the most beautiful things about the numbers release that we got from Tesla this morning was they said that in July, Tesla produced more vehicles than they have ever produced before. Well, if in the first quarter we were on pace of delivering 100,000 vehicles per month, then that means perhaps July could be somewhere at, let's be very generous here. Let's say Tesla produced 150,000 vehicles. Well, at 150,000 vehicles in 1 month, potentially, this could be 120, it could be 125, and quite frankly, it probably is. But at 150,000, this would put Tesla on pace for, think about it, 1.8 million vehicle deliveries. Oops, falling off the board there. 1.8 million vehicles per year, right? 1.8 million per year. The current projections have Tesla delivering somewhere around 1.4 million. And so if we can ramp to a pace where, wow, we're actually exceedingly coming out of Q2 with a substantial and successful ramp, then we're going to have good things coming to Tesla. Yeah, but what about layoffs? I mean, why would a successful company, one that's ramping, lay off 10% of their workforce? Well, here's the thing. If we're going into an actual recession, then companies need to pivot, and they need to pivot early. In fact, if companies pivot too late, then they suffer. And what that means is if there are early warning signs of a recession coming, companies coming out of a boom time should be trimming the fat. They should be laying off workers whom they really don't need. That might mean increasing worker productivity at those who remain. But it's very important to do this. In fact, I felt this in my own business in December. I hate to say it, but in December, we felt, we're getting a little bit too fat. We have too many people for the workload that we have right now. I'm a big fan of trimming expenses. I don't like having a lot of expenses. So we had to unfortunately lay off 3 of our workers. Now, I wasn't expecting this, but in April, 2 additional workers went on to an opportunity in another area, and whether or not that worked out for them doesn't matter. It's not the point of this video. But what the point is that we now have a very lean staff. And this is really important because it makes it a lot easier to survive going into a recession, to invest in new technology in the business, and to also launch new companies and new business ventures or new products, which are really important, especially if you could do those with fewer people. So I'm a big fan of this because you want to see companies with increasing earnings during a recession, not decreasing earnings. This becomes critical for Tesla because there are real expectations that we are going to be going through what's known as an earnings recession. An earnings recession is both when top line revenue year over year, comparing quarters, is negative, like we've already seen at Nike. We've seen negative year over year growth of about negative 1% over at Nike. Earnings tend to also then decline. In fact, earnings over at Nike are down about 5% year over year. And when we see these sorts of negatives, what do we end up getting? Well, we get a reduction of multiples because what are you no longer doing? You're no longer actually growing both revenue or earnings. You're actually contracting, and this is miserable for example, your PEG ratio, which takes the combination of your PE and your growth. But don't worry so much about that. What's important to know here is that layoffs are actually a good thing to prevent some of the pain of going through an earnings recession. So with that said, we should now get to some of our projections for Tesla and decide, okay, well, do we think there's the potential for Tesla to actually be a good investment in this sort of environment? Well, let's take a look. If we project out to 2025, this would be ramping, obviously, Tesla vehicles from about let's draw right here, from about 1.4 million vehicles, which is estimated for 2022, to a substantial ramping of somewhere around in 2023. We'll probably have to be, if we grow this at 50%, maybe even 60%, no more Shanghai lockdowns, then we could be somewhere around 2.2, 2.3. If we get to 2024, we could do that same kind of 50% growth rate. Hopefully we could be around 3.8, 9. Let's go with 9 here, going for a little bit more than 50%. And then another 50% on top of this is almost 2, right? And so that's how you could get to 2025 of about 5.8 million vehicles delivered. Obviously, we have to have demand for this, which right now it actually does seem like there is demand for Teslas in a substantial degree. One of the things that folks do say, though, is, oh, but why then are people buying Hyundais? You know, Bloomberg was just reporting that a bunch of Hyundai EVs are being bought and that they're outpacing Ford's EV sales, and they just launched their vehicles. Well, one of the problems you have right now that's quite ironic is there's so much demand for EVs that people are actually quite impatient for them, and therefore they're just picking up a legacy vehicle rather than waiting for a Tesla because they don't want to wait the 3 to 9 months. They decided they want a new car, and they want a new car this weekend. And historically, that's always been something that somebody has been able to do, especially older demographics. They don't like to wait for cars. They want their car now, which is ironic because usually people make fun of millennials for being impatient. But yeah, you check out the older demos when it comes to buying a car. It's like, I've decided I'm buying a car, I'm going now. Anyway, so look at this. If we have revenue per vehicle of about 52,000 here in 2025, which is absolutely possible, especially with the separating of the two different ADAS levels, 6,000 price option, 12,000 price option, that might even get more expensive in the future. There's some real opportunities here. At 5.8 million vehicles, we're going to have revenues of over $300 billion in revenue. Now, I'm going to take about 2.7% in leases. I think in the last report we were closer to about 4%. That's okay, though. We'll go with about 2.7 there. We've got servicing revenue, which is usually a break-even, energy revenue, and total revenues of somewhere around $355 billion. Now, the reason I put a bunch of zeros here, and I want you to see this right here. Okay, see all these zeros right here? I call this actually my personal margin of safety. Okay, this is a very Warren Buffett approach, although we know that Warren Buffett isn't into Tesla. A margin of safety is a way of saying, hey, I know a company can raise. I know that a company might grow faster than I expect, but I want to be conservative in my analysis. And even though I might match Tesla's growth estimates of 50 to 60% in their deliveries going forward, let's be conservative and just say Tesla makes absolutely zero money by 2025 in insurance, semi-trucks, robo-taxis, Tesla Optimus robot, or third-party FSD licensing. Any of these extra things, we're just going to call that part of the margin of safety, and we're going to call that bonus. I'm a big fan of that, and I think anytime you do a fundamental analysis, you should always include a margin of safety. If you do a fundamental analysis and you get to the point where you're having to include absolutely everything, then and then you're still trying to stretch the valuation, it's a red flag that maybe the company's a little overvalued. In fact, I did a fundamental analysis on a Square in our course member group about a year ago, and I'm like, oh my gosh. Even using like generous estimates for revenue and generous multiples, I can't justify this valuation. It's hard. Like, I'm stretching to justify this valuation. And when you're stretching to justify a valuation, you could be setting yourself up for a big old fall. And obviously we saw Square took a nice little tumble. So, okay, let's now get to margin. So these are expenses here. The most important thing, obviously we know this over and over again, that we want to watch for is right here. It is the 30% margin, gross margin on vehicles, or 70% expense ratio. Critically important. We actually have projections now that this could go as high from their Wall Street projections, that this could go as high as 32 to 34%, which would be remarkable. And again, seeing the S and X deliveries go up gives me some optimism for some higher margins. And then, of course, if we can sell more ADAS or we sell vehicles at higher premiums, then that's great. See, remember, right now, there are, maybe not so much right now anymore, but towards the end of last year, and still to some degree we see it this year, there are auto manufacturers that will sell and deliver a Prius to, let's say, DCH Toyota. Okay, so DCH Toyota, this is an auto group, right? Like a private equity kind of group of investors who run a company of vehicle sales departments and repair departments, service and sales, right? Those two big things. This is going to a dealership, right? And you might see that the Toyota Prius is selling for an MSRP of, let's say, $38,000 MSRP. But what happens is the dealer puts on a markup of $10,000 last year, maybe this year it's $2,000 or whatever, and they call it the dealer markup, okay? So the dealer markup, this extra money, is money that is going to DCH Toyota Unfortunately, Toyota themselves, this right here, is not benefiting from that dealer markup. And so that means even though dealers can charge more money because they have fewer volumes, and maybe they need to charge more money to survive because, again, fewer volumes. You know, you make $5,000 on one vehicle or $500 on 10 vehicles, but you don't have 10 vehicles right now. You charge a dealer markup because you have to survive. You got to pay the bills. You got to have the showroom going, right? Tesla doesn't have this extra layer, and this is something that's easily forgotten over at Tesla. That extra $10,000 in dealer markup, that goes straight to Tesla. And this is why they're raising prices, right? And that's going to help margin, I suspect, quite substantially because we've had quite a few increases on these. Now, so let's now talk about rates of return. What if Tesla, which currently has a 66 price to earnings ratio, maintains that going into 2025? Now, first of all, why would it? Well, maybe today's price to earnings multiple is depressed. Its 2022 price to earnings multiple is about 60 to 66. What if that's depressed because we're in a recession? Well, that means it could be higher in the future. What if we end up proving that Elon Musk can ramp Shanghai, its expansion, Berlin, and Texas all at the same time as building a plant in Indonesia and mining for lithium and potentially planning new gigafactories in Texas or Florida or even expansions in China even beyond Shanghai? Well then, folks, the 66 price to earnings ratio could actually be quite reasonable, but I think everything's going to come down to how well Tesla's able to prove that it's going to get to 20 million vehicles per year, which sounds quite lofty. And in 2025, we'll know, are we on that trajectory or not? Now, that multiple is not going to last forever. At some point, it will converge to 30. At some point, it'll converge to 20, and then sit around maybe where Google and Facebook are, which is closer to 14 to 15, right? So multiple is everything here. But at today's price of $690 for Tesla, if you have a multiple of 66 in 2025, folks, Tesla stock price should be $2,200. That represents an annual rate of return of 33.57% in 4 years. Every single year for 4 years, you would probably exceed the return of the S&P 500 by over 25%, compounded annually for the next 5 years. Now, there are a lot of folks who make fun of people who say, why would you only be in Tesla? That's so stupid. That's so stupid to only be in Tesla. And I'm not saying I'm only in Tesla. I'm just saying there are people who are like, why would I pick any other company? And there's a rationale behind this. That is to be in Tesla in this type of environment. And it has to do with something known as an immature company effect. And now we're going to talk about the immature company effect in a moment, but what I first want to do is I want to take this earnings multiple here and I want to slash that in half, okay? I want to see what these numbers would look like if we were only able to get a 33 times multiple in 2025. So here we go. 33 times multiple, which is not par with today. I forgot to take that out. It is not par with today. With a 33 times multiple in 2025, Tesla would actually be selling for about $1,100, which is funny because that's what it sold for in December of 2021. But we can't think about hindsight. We have to think forward. The point is, if you're buying shares at $690 today, oops, a little above that. If you're buying shares at $690 today, then whatever shares you're buying in the $690 region, you could potentially expect a rate of return on those shares of 12.3% over the next 4 years. That's pretty dang good. Even with these low estimates, you'd probably be exceeding Wall Street and quite frankly, the S&P 500 or the indices. Of course, in the short term, you might underperform, but that's what happens when you don't diversify towards the indices. Shorter terms, you'll underperform. So what is an immature company? Well, an immature company is a company that has so much excess demand. So think about it like Tesla, right? Let's say that this is a representation of all of the pre-orders for Teslas. And Tesla is only able to provide deliveries up to this maybe third of the box over here. Because remember, people might be tempted to buy other EVs right now because they can't get their hands on a Tesla, even though they'd otherwise be a Tesla buyer. Well, right here, this represents untapped sort of production growth, right? Production growth. And the only way to actually tap it is by growing production more. The issue is you can only ramp at a certain level. So even though next year we might be, able to ramp this by 50%, we might still only be here. And the cool thing about that is, with an immature company, if we say, oh, but wait, we're in a recession, we're actually going to stop demand at this vertical line here. And this demand is going to get destroyed. This could represent, let's say, 30% of demand over here. That gets destroyed. Tesla can actually still be growing and ramping at a rate of 50 to 60% growth, even without that 30%, because of the nature of it being an immature company. Anyway, if you found this information helpful, please consider subscribing. Check out the programs on building your wealth down below, and we'll see you in the next one. Goodbye.